there. Welcome to 2019, and we will work through the remainder of this unit. Last week means in December, just before we took a Christmas and New Year's break, we worked on topic 2 on internal controls. So what we will do today is continue to work on internal controls, but work on the second half of internal controls where we will apply internal controls or see the application of internal controls on accounts receivable and payable section of the business. Now, with the completion of this topic, you should be able to complete all the case study questions 1, 2, 3, and 4. And then next week, when we cover topic 3, we should be able to complete the remaining of the questions from this assessment. Now, remember, assessment is not due until 4th of February, so there's plenty of time, and hopefully that should give you enough time to settle back after the break. By next week, or towards the end of next week, I will send information for the tax unit, like the textbooks that you're required to purchase for the two tax units, and so that you can get organized. Again, you have the option to purchase the online textbooks or the hard copy textbooks, because just recently that publisher has made the e-text version available. So entirely up to you, but I'll give you, hopefully it should give you enough time to be able to purchase those textbooks required for tax. Do not purchase the textbooks yet until you hear from me, because maybe we might have to update the newer version to the tax books. So just hold on to buying those textbooks unless you hear from me. Okay, so let's move on and see what we have about internal controls on accounts receivable and accounts payable section. So we will look at the accounts receivable, mainly the revenue cycle, and that's where accounts receivable is raised in a business when from the revenue cycle of the business. Accounts payable is raised from the expenditure side of the business. Hence, they are called revenue and expenditure cycles. What we will look at is, we'll start from looking at what the flow of the transactions is for each one of those, but we'll start with revenue cycle and then apply the same things on expenditure cycle. And then the importance of a computerized revenue cycle, what outputs does it give, what are the control objectives, and segregation of duties, which we learned came across what the segregation of duties are, and what internal control requirements are in place by the corporate governance requirements in a business. And then we will apply those on revenue and expenditure cycles of the business. And we will also see how are internal controls used and applied on these two cycles. So to begin with, let's have a look at revenue cycle. What is revenue cycle? Revenue cycle relates to the exchange of goods or services with customers and collection of revenue generated by this activity, which is pretty much simple, and I'm sure you would be aware of this definition. Now, to design internal controls, as it says, we need to understand the flow of information in the cycle and the characteristics of the financial information needed by management. So unless we understand how the information flows within the revenue or expenditure cycle, we won't be able to understand what are the needs of the management and at what places within that revenue cycle we need to put internal controls in place so that any fraudulent transactions can be avoided from taking place. So here's how the flow of transaction takes place in a revenue cycle. Now, what you see is mainly related to credit side of the sale, because what you see is a credit check here. There's two types of sales transactions, credit or cash. In terms of cash, you will straight away receive money at the time of selling products. But when we are selling products on credit, the money will not come in at the time you have sold the product. Money will always follow later on, depending on what your business terms are. They could be 7 days, 14 days, 30 days, whatever the business terms are. Hence, this revenue cycle shows the credit side of the sales transaction. What happens usually in a business is customer places an order. That order helps raise a sales order. So through the customer order within the business, it becomes a sales order. When a sales order is raised or is to be raised, I should say, a credit check should happen on that customer. Credit check, for instance, within a business environment, there's always a credit limit placed on the customers. It could be $5,000, $10,000, $15,000, whatever the requirements are and the terms and conditions of the business are with each of the customers. Hence, the business will check the credit of the customer, whether they owe us any money, whether they are within their credit limit or not, and then based on that, sales are approved. Hence, this is a kind of check, right? Or an internal control, you can say. Once this is checked, an invoice is raised, and at the same time, a customer is shipped the goods. And then the customer receives those goods, and what happens is customer makes a payment when the whenever the terms are, whatever the terms are, the payment goes into bank, and then this raises some transactions which are recorded into journals and ledgers and filed in the business records. So this is what the revenue cycle is. Hopefully it makes sense, Jason and Naomi. Okay, perfect. Thank you for confirming that. So these days, a computerized revenue system or cycle is very much common. That means technology has made things quite easier and they are automated. This also increases the efficiency and reduces paperwork. Now, typically, input comes from a hard copy document and goes through one or more process in the computerized system. For example, customer order or a sales invoice is raised, then it would be in the hard copy document. And then that is processed. That means that is processed within the computerized system, and we store data in files and prepare data in the form of a report. So the types of reports that a business can generate will be many different reports, and I'll show you which reports are very common in the revenue cycle of a business. Now, internet sales, as I said, have become quite popular. They do raise some risks, both for the seller and the buyer, because there's always a chance that the systems can be hacked, they can be attacked by virus, or there could be transaction fraud that can take place. Hence, internal controls should be implemented to minimize those threats. For example, there should be antivirus protection within the computerized systems of the organization. There should be strong passwords so that hackers do not or are not able to hack your computers. There should be message encryption and firewalls put in place. And also, furthermore, internal controls that will avoid any fraudulent transactions taking place. And I'll talk about those in a minute. Monthly reports that are revenue cycle outputs are customer billing statements, debtor aging reports, bad debts reports, cash receipt forecast, customer listing, and sales commission reports. Now, the main objective in processing a sales revenue is to record the earning of income and to achieve timely collection of it in order to pay the bills of the organization. So that's the main objective, and that keeps the business running, right? If you don't have timely collection of revenue, then you won't be able to pay the bills. Hence, the business will be stuck. Probably going concern risks will arise. The business generally prepares performance reports, and there are two types of performance reports in the revenue cycle. First is a time analysis report, which is about customer order to delivery, how much time it takes since the customer has placed an order to receiving a delivery of the goods, and also invoicing to cash receipts. That means when the invoice was raised, how much time it took since the invoice was raised to the receipt of cash. Second type of performance report in revenue cycle is comparison analysis reports, which could be salesperson's expense to sales amount, how much expenditure was related to that sales that did take place, how much bad debt were against any credit sales, and also sales to advertising and promotion spending. So these are about understanding how the revenue cycle, how much profit the business is going to make through comparison analysis reports. Then the internal control objective for revenue cycle, again, is to ensure that the information for the period is complete, is valid, accurate, safeguarded, and can be used for reporting. Now, if you remember, or even if you don't remember, don't worry. This is what we covered in our last online session. Please bear in mind the revenue and expenditure cycle information that I'm sharing here through these PowerPoints is not in the textbook reading from last week's topic. When I say last week, that means in December, before the break. You were required to complete readings for chapter 8, and within that chapter 8 you would not find information on revenue and expenditure cycles. So this is only within these PowerPoints that I'm sharing with you. Although that gives you an overview of what internal controls are, what segregation of duties are, and what internal control objectives are. Hence, we are building on what we have learned in the last topic. Part 1 of topic 2. Then moving on, segregation of duties and responsibilities is important to an internal control system, and the fundamental requirement within the revenue cycle for the separation for the segregation and responsibilities of duties is that the business should not mix custodial responsibilities, record keeping responsibilities, and authorization responsibilities. What combination should be keeping in mind that these combinations should be avoided? Here they are. Segregation of custody and record keeping should always be separated. That means one person who has the custody of any item, say the accounts receivable data, should not be recording or should not, sorry, not custody of accounts receivable data. If the person has access to, say, assets, inventory, that person should not have access to record keeping of the inventory. So those two duties should be separated. Then is authorization and record keeping. That means if the person is responsible for raising an invoice or receiving and recording the customer order, that person should not have the responsibility of authorizing that sales and checking credit sales. So someone else within the organization should have that responsibility. Again, custodial duty and authorization should also be separated. So these functions within the revenue cycle should always be separated, because this will avoid any fraudulent transaction taking place. Controls over records and documents will be, the business should check credit checks on the customers before approving any sales. The business system should produce pre-numbered documents. That means when the invoices are raised, they should be pre-numbered, or there should be a sequence running in the invoices. It should not be random, because that's where the risk is, where invoices could be manipulated or sales could be manipulated. Authorized procedures for bad debts should be very carefully looked into. That means if the business is aware, say for example, accounts receivable officer is aware that one of their customers will not be able to pay the bills, then there should be some authorization procedure to record those bad debts into the system, and it should not be left on the accounts receivable clerk to write off the debts in the books. Hence, there should be some authorization procedure. Shipping documents, sales order, customer orders, and sales invoices should be reconciled very often, because without reconciliation, you would not get to know what you have missed. And this is where a lot of fraudulent transactions can take place. Accounts receivable should have control and subsidiary ledger and limited employee access to documents and records, mainly the accounts receivable and sales data. It should have everyone within the organization should not have access to these documents and records. Now, bear these things in mind, because when you're completing your case studies, these are the things that will help you answer those questions. Then, segregation of duties. Again, credit authorization function should be separate from handling cash receipts, sales, and billing functions. Specific authorization for non-standard transactions should be in place, and formal procedure for assigning customer credit limits should be in place. Say, for instance, a business has received a request from an existing customer to increase their credit limit. Now, the accounts receivable officer should not have the permission to increase the credit limit within the system. Hence, there should be a formal procedure that the manager or the finance controller is approving that increase in customer credit limit. These things will help avoid any problems in recording and recording the financial transactions that filter through to the financial reports. Hence, misappropriation of asset will be avoided, or even fraudulent transactions will not take place. At least it will be minimized, if not eradicated completely. So basic controls in the accounts receivable section will be for the completeness objective. Now remember, if you don't remember, sorry, I know we've come after a break, so it's all good. If we come across, if you go and do your revisions from the last week's topics, then you will see in chapter 8, we came across these objectives of control objectives, which were completeness, safeguarding, accuracy, validity, accountability, and valuation from chapter 8 reading. So for completeness, under accounts receivable, control should be record all transactions using pre-numbered and sequential documents and match them against each other. To safeguard, secure storage of debtor records, and accounts receivable staff should not handle cash. For accuracy, invoices should be checked and sent quickly. For validity, approval of sales order and credits given. Standard price list, approval of returns, and bad debt approval. Some procedure should be there in place for these things. For accountability, staff accountable for reconciling control and subsidiary ledgers and follow-up of slow payers should be in place. For valuation objective, monthly review of aged debtor reports and check on adequacy of allowance for bad debts should be in place. Further, These are the basic controls for cash receipts subsystem within the revenue cycle. For completeness, all receipts should be journalized. That means all cash receipts should be journalized. Mail should be entered on a pre-list, cash counted, and banked daily. For accuracy, receipts classified accurately, cash register tapes checked daily, and reconcile cash counted to receipts, summaries daily, and mailed open by 2 staff, and check any EFTs. For validity, all discounts need to be authorized. For safeguarding, make sure daily banking is in place and cash held in safe if banking is not done daily. And also, banking procedures should be strictly monitored. Accountability, set procedures for staff to follow, and bank reconciliation should be done monthly. For valuation, debtor balances need to reflect accounts receivable receipts. Now, here's a summary within this table. I'm aware this table because I copied and pasted it from a textbook. It is not very clear here, but I have saved this PowerPoint in the Blackboard site. So you should be able to download the PowerPoints, and you can change the size of this table, which is just a summary of what we've gone through. And this should be helpful in completing your assessment task case studies. And I think that should be okay when you download it in a PowerPoint slide. It's quite visible in that sense. Okay. Some businesses, well, it's not very common now, but it used to be that businesses, customers used to pay cash, mail cash. And what that type of transaction does is it's inherently very risky because cash is always susceptible to theft. So internal control objectives for mail on cash receipts is first that it should be safeguarded, accounted accurately, treated promptly, and recorded correctly. To do this, there should be segregation of duties in place. Person opening the mail should not have duties of banking, because that's where people can get greedy and they may not disclose how much cash was received in the mail, hence they could avoid banking it. They should not have duties of cash receipts, preparation of cash receipts, or accounts receivable entry, because if they have the responsibility of receiving the mail and also recording accounts receivable data, then they can manipulate that data. Mail opened in presence of 2 people, one a responsible officer and the other has mail duties, which should be rotated frequently. So these are some internal controls related to segregation of duties for cash receipts in mail. Safeguarding assets. Checks received should be endorsed and immediately stamped, not negotiable, and account pay only. Proper documents and records. Checks should be listed to establish a control total and the name of payer and amount remitted. Check list should be signed when handed to a cashier and a copy sent to accounts receivable with remittance advice, and another copy should be sent to the general accounting. So notice there are 3 sets of copies for this checklist. Then moving on, independent reconciliation and verifications. Under this, control list should be reconciled by daily banking deposits, credit to customer accounts, and bank totals should be independently verified. So here's a summary of controls over cash receipts in a table format. This also tells you what type of control is being tested and the control strategy to be put in place. Okay, any questions so far? No questions. All right then. Let's move on. Let's work on the internal control systems for the expenditure cycle. Now, expenditure cycle relates to the purchase and payment of goods and services and other assets. Accounts payable and cash payment subsystem are the parts which are the major parts of expenditure cycle. This is what expenditure cycle, the flow of transactions in expenditure cycle looks like. It starts with purchase requisition. Purchase department is purchase department requests a purchase order, and then the vendor is contacted for the items that are required. When the vendor is contacted, vendor will be sending the goods and the delivery docket to the stores wherever they are located or from, or wherever the business has requested the goods to be delivered. And at the same time, vendor will be raising an invoice that will be sent to the accounts payable department of the business. Against it, the payment will be received, and then this information will be recorded in the business's ledgers and financial reporting. Now again, this expenditure cycle raises some internal control threats. Many purchasing systems are computerized. Well, it does have some benefits. For example, greater control over stock, because you will be able to know when the business is about to run out of stock. Better record keeping of stock levels. Enhanced purchasing department efficiency and effectiveness. Cash management is again enhanced by computer, as the computer keeps the records when invoices become due. And real-time data input improves controls by shortening lag time and also eliminates the manual procedures, which of course reduce the paperwork. Monthly reports that the expenditure cycle produces is financial statement information, vendor checks, check register, any discrepancy reports, cash requirements forecast, purchase analysis reports. It could also be supplier payment reports, accounts payable reports, which is aged accounts payable reports. So these are some of the reports, monthly reports that expenditure cycle produces, and very useful reports because it helps a business analyze the transactions and also the wealth of the business. Performance reports are purchase discount lost if business doesn't lose any discounts. This is what performance reports will be able to inform, and the business managers will be able to analyze that. Time analysis report, which is about inventory request to order placed, how much time it takes when the inventory was requested and when the order was placed. Order placed to goods received and goods received to invoice recorded. So these are the two types of performance reports: purchase discounts lost and time analysis reports. Generally, when the business is buying on credit, there will be credit terms in, and very often this is a very common practice in businesses to increase their cash flows. What they do is they offer some discounts for quick payment. For example, sometimes businesses will write on the invoice 2 for 10, as I've written in the chat box, 2 for 10. That means 2% discount if the payment is received in 10 days, otherwise none in 30 days. That means no discount and no discount in 30 days. And that's how it is mentioned on the invoice. Hence, if the business is able to not take up those discounts, 2% discounts, those will be reflected in the performance reports of the business. Then moving on, we will look at the internal control objectives. Internal control objectives in the expenditure cycle are the same as for revenue cycle, but they work on the, of course, expenditure cycle. So the objectives are, transaction should be complete, that is, all transactions are recorded. Transaction recorded is valid, that is, transactions are properly authorized and fair price paid for it. It is accurate, goods ordered are what is received and reflected in the invoice. It is safeguarded, credit records restricted to authorized staff only, and can be used for reporting, that is, accountability purposes. Following duties should be segregated in expenditure cycle: segregation of custody and record keeping, segregation of authorization and record keeping, and custody and authorization duties should be separated in expenditure cycle. Adequate controls over records and documents, that is, authorization of purchase requisitions, should be in place. Again, sequentially pre-numbered documents, that is, if a payment is made through checks or EFTs or any other way, then those records are pre-numbered and they should run in a sequence. That will help identify any errors or any mistakes, and will also help keep the record in order of a business. Authorization procedures for the payment of invoices should be in place. Purchase orders, delivery dockets, and invoices should be reconciled. And accounts payable should have a control and subsidiary ledger, and finally, limited employee access to goods received. Segregation of duties that must be separated are authorization of purchase requisition, recording of goods received, and custody of stock. Basic controls for completeness in accounts payable section is that all purchase orders and receiving reports should be sequentially numbered. Invoices and receiving reports should be checked against these orders to help check the completeness of those transactions. For accuracy, invoices should be checked against order and receiving report. For validity, purchase orders, received items, and invoice need to be approved. Vouchers should be stamped, paid immediately once the payment is made, and all payments should be authorized. For safeguarding, secure storage of accounts payable records, no accounts payable staff to handle cash. For accountability, staff need to be accountable for the reconciliation of control and subsidiary accounts, ensure creditors are paid within 30 days. And for valuation, monthly review of aged creditors report should be in place. For cash payment subsystem, all payments should be journalized to check completeness. For accuracy, check cash payments daily. Classify payments accurately, check payments against summaries. For validity, all discounts should be authorized. For safeguarding, make sure daily banking is in place and cash held in safe. Accountability, set procedures to follow to make cash payments, and reconciliation should be done monthly. And for valuation, creditor balance needs to reflect accounts payable payments. Okay, that brings us to the end of this topic. Let me ask you if you have any questions or something you'd like to share. I like it. What's for dinner? Well, we had sushi, Jason, already done. Dinner done and dusted. A good one. Okay. Dessert there for you, Jason. With the completion of this topic, you should be able to complete case studies 1, 2, 3, and 4 of your assessment. Now, please do not forget to review activities 2.1, 2.2, and 2.3. You will find 2.1 to be quite helpful. Actually, it's very similar to your assessment question. And there's a reason that it has been kept in that way, just so that you see the process of how the transactions are recorded and what are the items that you need to pay attention to when purchase order is raised or a receiving report is received, or within the tax invoice, what could be the problems. So have a careful look at what the examples are, what the activities are, and then give it a go. And if any questions, then we might look into it next week. But for now, that's all. And next week, we will be looking at topic 3, which is audit and governance of accounting information system. Now, this will be topic 3, will be the last topic for this unit. It's not a big unit, but we'll have 2 more weeks to complete the assessment. And then afterwards, we'll start with the major units on tax. So that's all from my end for tonight. Thank you very much. And I'll stop the recording.